Opendoor stock has been one of the best performing stock this year, returning more than 200% year to date, and the stock was much higher a week ago, up more than 300% for the year. However, the company recently reported Q2 earnings results and the stock crashed more than 25% in a single trading day. The question is this the start of a bigger sell-off or is this a buying opportunity? Well, that's what we're gonna cover in today's video. We'll talk about Opendoor's Q2 earnings results, its valuation, and what it means for investors today. And full disclosure, I do have a position in Opendoor stock, so you might want to stick till the end to find out what I'll be doing with the stock. Also, if you prefer to read the article version of this analysis, you can find the link to my Opendoor article in the description box below, where I cover Opendoor in much more detail. And with that out of the way, let's take a look at Opendoor's Q2 results. Looking at the growth of the company, in Q2, revenue was $2 billion, which is down 53% year over year. And despite the slowdown, Q2 revenue exceeded the high end of Opendoor's revenue guidance by 7%, as well as beat analyst estimates by $140 million. And the better than expected performance was due to strong market clearance rates and the sell-through of its old book of inventory. Nevertheless, the revenue drop was primarily due to high interest rates, which negatively impacted sales volume as well as home prices. Revenue growth and acquisition volumes go hand in hand, meaning in order to sell more homes, Opendoor needs to buy more homes first. And that's what Opendoor did back in 2021 and 2022. They were acquiring as many homes as possible back when the housing market was really hot. And as you may know, the Fed began hiking interest rates in Q2 last year, which caused mortgage rates to spike, causing a drop in housing affordability as well. The problem was Opendoor had acquired way too many homes, and with demand drying up, Opendoor had no choice but to slam on the brakes and slow down the pace of home acquisitions, and the company did so by lowering marketing spend as well as increasing spreads embedded in their offers. With lower home acquisitions, Opendoor can focus on offloading their old book of inventory, but this also means that the company is bringing in less inventory or fresh inventory, which is why sales have been down over the last few quarters. As you can see, homes purchased in the last 4 quarters were down significantly compared to the previous year, and in Q2, Opendoor purchased 2,680 homes, which is down 81% year over year. In addition, the company sold 5,383 homes in Q2, which is down 49% year over year, and again, the decrease in sales volume was due to slowdown in home acquisitions over the last few quarters, which resulted in fewer homes in inventory that can be sold. As you can see, as of Q2, Opendoor had 3,500 homes in inventory, which is down 79% year over year, which also meant that Opendoor has very few homes that they can sell, thus leading to weak Q3 revenue guidance, which I'll talk more later in the video. With that said, it's also important to note that the housing market is a cyclical industry, and the growth of the industry depends highly on monetary policy, which is how high or how low interest rates are set. And given that interest rates are almost at their cyclical peak, and given that the Fed is likely to cut rates next year, Opendoor is likely to return to growth mode heading into 2024. But whatever it is, Opendoor offers one of the most compelling value propositions in residential real estate, and over the long term, I believe more people will realize the true benefits of iBuying, and more people will adopt Opendoor's fast, simple, and transparent services, which is why I think Opendoor still has a long growth runway ahead. Turning to profitability, gross profit for the quarter was $149 million, which represents a gross margin of 7.5%. While gross margins look robust, it's better to look at adjusted gross profit, which aligns the timing of inventory valuation adjustments to the period in which the homes are sold. In other words, adjusted gross profit tells us how much profit or loss Opendoor made for the homes that are sold in the quarter, regardless of when they are purchased. With that in mind, adjusted gross profit turned profitable once again, just slightly though, at just $7 million in Q2, representing an adjusted gross margin of 0.4%, which is well below GAAP margins. That said, the drop in gross margins year over year is due to the weakness in the housing market, as well as management's decision to prioritize resale clearance in order to clear old inventory acquired before the housing downturn last year. Moving on, contribution profit, which accounts for direct selling costs and holding costs, was negative $90 million in Q2, which represents a negative 4.6% contribution margin. The drop in contribution margin year over year was due to the company selling old inventory at losses, as well as higher holding costs due to longer average inventory holding periods. But despite the year-over-year decline, we can see that contribution margins bottom in Q1, and in fact, we can start seeing contribution margins turn positive again in Q3. That's because, according to management, Opendoor has sold 99% of its old book or its loss-making Q2 cohort. And the reason why overall contribution margins are still negative in Q2 is due to the fact that the old book of inventory make up 57% of Opendoor's resale mix in Q2. As you can see, Opendoor sold more homes from its old book, which has a contribution margin of negative 14.3%, while Opendoor sold fewer homes from its new book, which has a positive contribution margin of 10.6%. So because of this mix, Opendoor's overall contribution margin is still negative in Q2. However, as management pointed out, the company has reached an inflection point and expect the new book to make up the majority of the resale mix moving forward, which should drive positive contribution margins, so that's really great to hear. Moving down the income statement, Q2 GAAP net profit was $23 million, which is a 1.2% GAAP net margin. As you can see, Opendoor returned to positive GAAP net profit in Q2, but keep in mind that this is due to a $104 million gain on extinguishment of debt, so without this item, Opendoor would still be unprofitable on a GAAP basis. That's why we look at adjusted net margin, which is the gray line right here, which was negative 10% in Q2, and as a reminder, adjusted net profit also aligns the timing of inventory valuation adjustments to the period in which the related revenue is recorded. That said, just like the other metrics, adjusted net margins seem to have bottomed, which is great to see. All in all, Opendoor is at an inflection point and the company should be done selling its loss-making Q2 cohort, and when they do, Opendoor can turn over a new leaf. In other words, margins should improve moving forward as Opendoor's higher margin fresh book of inventory make up the majority of its resale mix, which should drive profitability in future quarters. But without an annual revenue run rate of at least $10 billion, Opendoor won't return to sustainable cash flow positivity, so Opendoor needs to balance growth and profitability, and only then will Opendoor generate immense shareholder value. Turning to the balance sheet, as of Q2, Opendoor has $1.2 billion of cash and short-term investments with $3.1 billion of total debt, which puts its net cash position to be about negative $1.9 billion. Opendoor has a capital-intensive business model, so it's not surprising to see a negative net cash balance. However, net cash position is improving over the last few quarters, as you can see right here. And the company is reducing its debt balance this quarter by repurchasing $279 million of its outstanding 2026 convertible notes, as well as closing the last of its two Q2 cohort financing facilities, so that is really great to see. As mentioned earlier, Opendoor ended the quarter with 3,500 homes in inventory, valued at roughly $1.1 billion in Q2. This figure is down 46% from the prior quarter or 79% from a year ago, so Opendoor has very few homes to sell to generate revenue. But do note that as of Q2, approximately 22% of the inventory balance consists of the old book, which is down from 66% in Q1, which reflects the company's incredible progress to offload these older homes. As you can see, inventory valuation adjustments as a percentage of inventory, which is management's estimate of future losses that Opendoor may realize on these homes, is really high for the old book at about 13.9%. Which is why management wants to get rid of these loss-making homes and move on to their new book of inventory, which has a much lower adjustment rate of just 0.4%, which is also consistent with historical performance. And it's also worth mentioning that only 9% of Opendoor's new book of inventory had been listed on the market for more than 120 days versus 16% for the broader market. This means that Opendoor's new book is selling faster than the general market, which means faster revenue generation and lower inventory holding costs for Opendoor. So that is great to hear. Turning to free cash flow, Opendoor generated $931 million of free cash flow in Q2, which is a 47% free cash flow margin. As you can see, Opendoor has positive free cash flow in the last 3 quarters, which means that the company is a net seller of homes. This is of course because of management's focus to sell down their old inventory. But once this old inventory is completely sold, I expect Opendoor to ramp up home acquisitions, which means that they will be net buyer of homes once again, and that we can expect free cash flow to turn negative when that happens. Moving on to the outlook of the business, management provided the following guidance. Q3 revenue is expected to be about $950 million to $1 billion, and this is a 50% sequential decline or a 71% year-over-year drop, and this is also well below analyst estimates of $1.36 billion, which is a major reason why the stock sold off following Q2 results. That said, given the fragile macroeconomic environment, I think it's wise for management to maintain higher spreads and operate at much lower volumes, and I think they don't want to make the same mistake twice of buying too many homes and scaling too rapidly. And I think it's good that they're balancing growth, profitability, and risk management, which makes a more sustainable operating model. But because of this lower volume, adjusted EBITDA is still expected to be negative at about negative $60 to negative $70 million. And again, Opendoor needs to scale to achieve profitability. On the other hand, stock-based compensation is expected to be $35 million and adjusted operating expenses is expected to be $100 million, which is an increase from this quarter's $78 million, and that reflects management's expectation to begin rebuilding inventory in Q3. Management also said that they expect the second quarter to mark the last quarter of negative contribution margins and expect to deliver positive contribution margins in Q3 and perform within its 5 to 7% contribution margin target by Q4. In other words, profitability is set to improve from here, which is great news. And more importantly, Opendoor is on track to return to positive adjusted net income at an annual run rate of $10 billion, and given the performance and outlook today, I expect Opendoor to achieve that by the end of next year. Whatever it is, Opendoor is still in its early stages, and I think the company still has a long growth runway ahead. As mentioned by management, only 1% of the $1.9 trillion of US residential real estate transactions are conducted online today, even though the traditional process remains complex, uncertain, and broken. And despite the low penetration rate today, Opendoor is gaining massive traction, especially in its longest tenured market, where it achieved 3.8% market share by 2022, with 39% of the homeowners coming to Opendoor to get an offer. In other words, Opendoor has the potential to expand market share in both new and existing markets, and with almost 80% market share in the iBuying space, Opendoor is well positioned for growth for years to come. Looking at valuation multiples, we can see that Opendoor still trades at depressed levels. Currently, Opendoor trades at an EV to revenue multiple of just 0.4 times, which is far below its peak of 7.6 times and its average of 2.1 times. So from a historical standpoint, Opendoor looks very cheap. But let's take a look at my updated DCF model. I think in my previous video, I valued Opendoor stock at $4 a share, but let me give you an update on my DCF model. That said, here's my DCF model and here are my key assumptions. And as always, for revenue growth, I follow analyst estimates for the first 3 years and then gradually drop growth rates to just 18% by 2032. This translates to an annual revenue run rate of about $45 billion by 2032, which is only triple the revenue last year, so I think this is very conservative. As for gross margins, I think management is going to be quite conservative when it comes to growth, so I expect them to maintain higher than normal spreads in their offers, which will lead to higher gross margins. As such, I expect Opendoor to achieve a long-term consistent gross margin of about 10% as the company gains economies of scale and introduce higher margin products such as its 3P marketplace exclusives. Moving on, I expect the company to gain operating leverage as well, and I expect operating expenses as a percentage of revenue to decline over time from 10% this year to just 8% 10% by 2032. This leads to a long-term operating margin profile of about 2% by 2032, which again is very conservative. As for depreciation and amortization, SBC, CapEx, and changes in net working capital, I'm going to set them all at a constant rate of 0.8%, 1%, 0.4%, and 0.1% respectively, as you can see right here. So based on all these assumptions, I expect Opendoor to achieve a free cash flow margin of about 3.1% by 2032, which is at the upper end of management's long-term target of -2% to 4%. And assuming a discount rate of 12% and a perpetual growth rate of just 2%, I arrive at an intrinsic value per share of about $7.88 for Opendoor, which is higher than my previous price target of $4. And the reason for the upward revision is due to the fact that I was too conservative with my estimates of Opendoor's margin profile. That said, with the current price of $3.42, I see a potential upside of about 130% for Opendoor stock. And keep in mind that this is a 1-year price target and I have no way of knowing where the price will go over the next 12 months. And this is just my price target. It's not financial advice and I can be wrong. I can be very wrong, so don't forget to do your own due diligence. But looking at Opendoor's price chart, we can see that the stock is up significantly since its May lows this year. However, after releasing Q2 results, Opendoor crashed more than 25% in a single trading day, most likely due to weak Q3 guidance. In addition, I think there's a lot of people taking profits given the recent rally that we've seen. But using the Fibonacci retracement tool, we can see that Opendoor has retraced 50% of its rally, and I won't be surprised if the stock continues to sell off and retrace to the 61% to 78% line right here. That said, after trading below its 200-day moving average, which is the dark orange line right here, we can see that the price is finally trading above the 200-day moving average. So the primary trend is now up and hopefully that trend continues. I'm not saying Opendoor stock will only go up from here. I'm saying that it is the path of least resistance and that it is the most likely outcome. But moving on, even though I think shares are undervalued, insiders have been selling their shares. Most notably, Opendoor founder Eric Wu recently filed to sell $20 million worth of Opendoor stock. Although he still owns 20 million plus shares, which is worth about 60 million plus today, a major owner selling shares definitely raised a yellow flag. But the bigger concern in my opinion is that despite the lower share prices, insiders have not been buying shares at all, which doesn't really give the confidence that long-term investors need. But hopefully over the next few months or so, when business and market conditions improve, we can start seeing insiders acquire Opendoor stock, which I think is going to be a major catalyst for the stock. Quickly going through the risks, the one obvious major risk is high interest rates. As you can see, after a period of ultra low interest rates in 2020 and 2021, the Fed hiked interest rates beginning in 2022, which was done at record-breaking pace. And now interest rates are at the highest level since the great financial crisis, and if interest rates continue to increase or remain high, housing affordability will remain low, which is likely going to limit Opendoor's growth. This also brings us to the next risk, which is another housing crash. As we've seen last year, Opendoor failed to take into account the effect of rising interest rates on housing prices, which caused the company to overbuild its inventory and subsequently sell them at huge losses. If we see another housing crash, we could see Opendoor's contribution profit dropping to negative territory again, which could re-rate the stock lower. The good news is that Opendoor is more prepared than ever to deal with another housing crash, but the risk is still there. My overall investment thesis on Opendoor is very simple. Opendoor operates as a virtual monopoly in the iBuying business, and with 1% market share in the massive residential real estate industry, Opendoor has a long growth runway ahead as the company builds an end-to-end platform for people to buy and sell homes with simplicity and certainty. This has been my investment thesis ever since I bought Opendoor stock, and it has not changed one bit. I understand that Opendoor is dealing with a lot of challenges, including high interest rates and volatile home prices, but as management pointed out in Q2, the company is at an inflection point as it sells off its Q2 cohort and can now focus on selling its higher margin fresh inventory. As such, contribution margins are expected to improve in Q3 and Q4 and beyond, and it won't be long before the company achieves the $10 billion revenue run rate that it needs to achieve adjusted net income profitability. But despite the improving outlook, Opendoor stock sold off after Q2 earnings results, which in essence gives investors another chance to buy shares at a discount. And as for me, I will continue to hold on to my Opendoor position and maybe add more if we see the price dip close to the 200-day moving average. With that said, that's all that I have for you today. If you find value in this video, don't forget to hit like and subscribe so you won't miss future investment content like this. As always, I appreciate you and I hope you have an amazing day. See you guys on the next video.